At first glance, life insurance seems like an odd product to talk about in the context of retirement income planning. But today, I want to talk about three components that focus our attention on this product and why we try so diligently to get as much cash value built up inside life insurance products as possible. So everything I'm going to say today applies to dividend-paying whole life insurance as well as indexed universal life insurance. They are effectively the same for all of the purposes of today's discussion. And I want to start today's discussion on the subject of taxes. Life insurance, cash value life insurance specifically, comes with a boatload of tax benefits. We have tax-deferred growth, we have tax-free distributions, and we have tax-free transfers to other products that carry tax preferential benefits for the sake of income producing, primarily annuities. So the cash value that accumulates inside a life insurance product, cash value life insurance product, does so tax deferred. This means that every year you earn interest and or dividends on cash value in your policy, and you do not receive a 1099 for that growth in the cash. So unlike your bank account or maybe a general brokerage account where you might own mutual funds and a capital gain is passed on to you, or a dividend is received from a stock or mutual fund that you own and you owe ordinary income taxes on that distribution, none of that happens with life insurance. It doesn't matter if you earned $1 on your cash value or $100,000 on your cash value. Any growth in the cash buildup inside of a life insurance policy year over year, so long as it stays inside the life insurance policy, does so tax deferred, which means no tax liability to you for the growth of cash value inside your life insurance policy. In addition to this tax deferred growth, you can distribute the cash inside a life insurance policy without incurring a tax liability. This takes shape in two distinct ways. One is a withdrawal of your cost basis in the policy. Life insurance premiums are paid with after-tax dollars, and life insurance enjoys an accounting principle we generally call FIFO, or first in, first out. This means that if you withdraw money from a life insurance contract, you have the ability to take out your already taxed basis, your contributions, before you have to take out any of the gain in the policy. This is very different from a lot of other assets, which would require you to take out the gain first, and then once that's exhausted, you can take out your non-taxable basis. In addition to all of this, life insurance policies have the availability of a policy loan. So when you take a loan against a life insurance contract, it does not create a taxable event to you. This means that you can distribute money from a life insurance contract. You can even distribute gain from a life insurance contract without actually incurring an income tax liability. So regardless of how much of your cash value is basis that you contributed yourself, premiums that you paid, or cash that has simply accumulated by the payment of interest and or dividends, you can access that without incurring an income tax liability. This has substantial implications when it comes to how you might access value in your assets that you hold for a number of different possible reasons. Take, for example, a situation where you would like to withdraw $50,000 from your life insurance policy or any other asset that you happen to have. It's not really important where it comes from. You just need $50,000 for some reason. If you sold assets, let's say stocks or bonds, you may incur a capital gains tax in that situation. If you withdrew it from your retirement accounts, there's a good chance you would pay ordinary income tax on it unless it were Roth money. And you may also pay penalty taxes on that. But from life insurance, you can access all $50,000 without adding $50,000 to your regular income, which means you don't have to worry about being in a higher income tax bracket. You don't have to worry about grossing up the withdrawal to ensure that you net $50,000. You can just take $50,000 out and not have to worry about taxes. This can be done at any time and for any reason. So you don't have to worry about getting to age 59 and a half, for example. You could be 45, you could be 35, you could be any age. And the great thing is you don't have to worry about additional consequences related to taxes because of the unique way life insurance distributions can be accessed. On top of this, because there is not an income tax liability to life insurance distributions, provided that they are basis recoveries or loans, they also don't impact other aspects of retirement when you have additional income. Social Security is a wonderful example. So, as you may or may not know, income that you derive in retirement while you are collecting Social Security can have an impact on the taxability of your Social Security income. After certain levels of income earned, which is not that much, you will owe at least some degree of taxes on the Social Security income that you receive. Life insurance does not count towards this income allotment. This means you can take income from life insurance contracts to any degree that you want. Couple $1,000s, tens of thousands of dollars, hundreds of thousands of dollars. It will have zero impact on the taxability of your Social Security income. Lastly, on the tax item, you can transfer value inside a life insurance contract to another life insurance contract or to an annuity without having to recognize income for any of the gain inside the life insurance contract. This is done via a section of the tax code that falls under 1035. That's why we generally refer to it as a 1035 exchange. But the other cool thing about transferring values in a life insurance contract to a new life insurance contract or an annuity via 1035 exchange is the fact that you get to keep your tax basis in the old contract as you bring it to the new one. So, for example, if you transferred the cash value in a life insurance contract to an annuity and then use the income feature of the annuity, you can take advantage of the exclusion ratio, which allows you to create income that is part basis and part gain, which significantly reduces the amount of taxable income that you have to recognize from the annuity payments. So, for example, if you transferred $500,000 of cash value in a whole life policy to an annuity, and let's say that your cost basis in that whole life insurance policy is $300,000, a huge percentage of your income amount, more than 50% in fact, will be non-taxable recovery of cost basis. So as you receive a monthly check from the annuity, a big percentage of it isn't taxable to you. Another substantial benefit that life insurance brings to the table as a retirement planning tool is an extremely high contribution limit. So unlike, for example, an IRA, which currently has a $6,000 per year contribution limit, life insurance is, practically speaking, nearly limitless with respect to the amount of money you can contribute to a policy. Now, I assure you that technically speaking, there are some degree of limit because the insurance company is going to look at your income and need to justify the amount of money you're paying to the policy based on your financial circumstances. But the amount that you could contribute to life insurance, annually speaking, is far higher than caps like IRA limits that you have. Couple that with all of the tax benefits we just talked about, and you start to realize that you can put a substantial amount of money away in a very tax beneficial way by using life insurance as a component of your retirement planning. So over and above contribution limits like the IRA limits or even 401k limits, you can put tens of thousands, we've even had people put hundreds of thousands of dollars per year into life insurance contracts as a means to build retirement preparedness. And lastly on our list is risk diversification. Life insurance behaves very differently when it comes to economic circumstances than the rest of the market does. Stocks and bonds are commonly thought of as substitutes for one another when it comes to risk appetite. You buy stocks if you like riskier bets, you buy bonds if you like safer bets. And there is some theoretical evidence that holds that true. But empirically speaking, we have absolutely seen times, very recently in fact, where economic conditions can make stocks and bonds decline in value at near identical amounts. And in those situations, a lot of people start to worry that in truly trying economic times, there's simply no place to hide. But that's not true if you use life insurance as part of your portfolio. Because life insurance contracts, by their very nature, have extremely solid principal guarantees. Whole life insurance is guaranteed every single year to increase in value. And indexed universal life insurance has a guaranteed floor that limits the amount of money that you might lose in a contract to the expenses of the policy if you simply end up not getting any interest payment on your cash value. This makes for a wildly diverse risk profile versus stocks, bonds, commodities, real estate, anything else you could possibly wander into as part of your retirement portfolio building. Life insurance has an ironclad guarantee that is cash-like, but a rate of return expectation that is many, many multiples of what we would expect from cash on a long-term basis. So there you have it. A boatload of tax benefits, a substantially higher contribution limit, and true risk diversification through a product that is absolutely not correlated with broader markets. Life insurance brings a lot to the table, but it's important to understand that you have to build life insurance policies in a way that maximizes the cash value from them. Sure, you can get all of these benefits from regular whole life insurance, but you can get so much more from life insurance that is built to optimize the cash value accumulation inside the contract. And if you want to know more about how we do that, check out this video.